On December 29th, 2025, silver dropped more than $10 an ounce. It fell from around $84 to near $72. Nothing dramatic happened in the real world. No new mine opened, no demand vanished, yet traders everywhere felt the shock. I want to start by saying this clearly. This was not panic. This was math. If you were holding silver futures that day, you probably felt it before you understood it. Positions that looked fine suddenly were not. Screens turned red without headlines. Explanations came later. That is always how mechanical moves work. Price reacts after structure breaks, not when stories change. Let me explain what actually happened. In early December, CME raised initial margin on silver futures from roughly $20,000 per contract to about $22,000. That single change quietly removed leverage, no drama, just tighter rules. Most traders did not panic then. They adjusted. They assumed this was manageable, but the pressure did not leave the system. It compressed. And it concentrated in the most active contracts like March, May, and July silver futures, where open interest was highest. Then came the second move. On December 29th, CME raised margin again. Initial margin jumped near $25,000 per contract. Maintenance levels moved up as well. 2 margin hikes in 1 month. That matters more than most people realize. Here's why. Traders plan funding weeks in advance. Capital is allocated. Cash buffers are finite. When rules change twice in quick succession, leverage does not shrink gradually. It collapses. Selling did not begin with fear. It began with margin calls. Accounts dropped below thresholds automatically. Brokers raised house margins above exchange levels. Traders had 2 options: add cash immediately or reduce positions. Liquidity vanished before price moved. Bids pulled back. Depth thinned across front-month contracts. Rolling positions forward required more collateral. Many chose to exit instead. This selling had no opinion behind it. It followed rules, not beliefs. This is why silver fell from 84 to 72. Not because silver suddenly became worthless, but because leverage was forcibly removed from the system. Futures markets set marginal price. When futures unwind, spot follows. Always, if this feels familiar, it should. In 1980, during the Hunt brothers episode in the United States, COMEX raised silver margins repeatedly within weeks. Margin requirements increased more than 300%. Silver collapsed from nearly $50 to below $20. Demand did not disappear. Leverage did. The same thing happened in 2011. Silver rallied to nearly $50 an ounce. CME raised margin requirements 5 times in 9 days. Margin nearly doubled. Within weeks, silver dropped more than 30%. Again, not panic. Structure. Every time COMEX tightens margin aggressively, prices fall after leverage exits. This is not manipulation. It is risk management doing its job. Whether you like it or not, margin is the gatekeeper of price. Now bring this back to today. In 2025, pressure was already building in United States derivatives markets. CME clearing began tightening margin requirements in October. Clearing members imposed additional house margin above exchange minimums. Funding costs rose quietly across prime brokerage lines. Free collateral became scarce. By December, most capital was already committed. Traders entered year-end with little spare cash. Stability existed only because stress had not been tested. The system looked calm, but that calm was artificial. It was enforced by rules. Year-end made everything tighter. Commodity index funds rebalanced automatically. Profitable positions were trimmed by mandate. Futures rolled forward into new months. Rolling required more collateral. Exposure was reduced without discretion. At this point, many ask the wrong question. They ask whether this is the start of a major collapse. I do not see it that way. This looks more like a breather inside a broader uptrend. A reset, not a reversal. Here is why. Physical buyers did not back off. Industrial demand remains intact. From January 1st, 2026, new supply constraints are expected to tighten availability. When supply tightens, buyers move early. The United States and global market rely on concentrated refining and processing flows. When exports or logistics tighten, supply becomes less flexible. Price sensitivity increases. This matters because the market already runs a deficit. Industrial demand keeps rising. Solar, electronics, and energy storage all need silver. Physical buyers do not answer margin calls. They wait for leverage to clear, then they step in. Forced selling removes fuel from the downside. Once margin-driven exits are done, sellers are exhausted. Liquidity becomes thin again, but this time on the upside. That is how sharp rebounds begin. This is why some expect another leg higher. Not because of hype, but because structure resets under constraint. Under these conditions, targets like $100 in early 2026 become plausible. This does not mean the path is smooth. Volatility will remain. More leverage may still be present, but this drop does not end the story. It changes its timing. So ask yourself this. Was this manipulation, or was it simply math catching up? I'm curious what you think. Drop your view in the comments. If this breakdown helped you see the market differently, like and subscribe. In the next video, I will walk through how traders position after a margin-driven reset like this and what signals matter most for the rebound.